What's happening, everyone? Welcome to the California Real Estate Investor Podcast. I have with me Jeb Smith. Jeb is what I call a data and market trend whiz. He won't admit it himself, but love him. He has a great YouTube channel. He's been a real estate agent in Orange County as well for 20 years. Hi, it's Alan here from the California Real Estate Investor Podcast. I want to share with you two cool free resources. First of all, our Facebook group, California Real Estate Investor. I'll put a link in the show notes. You can connect with us there, share stories, share about what you're doing, where you are in California, and we look forward to that. And then secondly, the website, the CaliforniaRealEstateInvestor.com. I've just uploaded a free mini course about flipping luxury homes. You can download there. If you're flipping homes and you want to make more profit per deal by going higher end with your flips, that's a great resource for you. So check that out. I look forward to connecting with you on the other side. Jeb, how are you doing today?
I'm doing well, Alan. I appreciate the opportunity to come on. Always love talking real estate. California real estate's not something I talk about as much as I would like to, so looking forward to the conversation.
Yeah, absolutely. I have heard you talk a bit about, just some of the data. And what I love about when you talk about data is it actually, I can tell you enjoy it, or at least you're really good at pretending you enjoy it, but you really get into it. I struggle with data, to be honest with you. So when you're talking about it, I get pretty excited, and I think we're a lot on the same page. A lot of people, let's maybe first start talking about where the market is right now, and then we can talk a bit about where the market may be headed. The big thing on people's mind right now is interest rates. So I think we could talk about that. Is that the biggest topic you're hearing the talk about?
Yeah, I mean that and affordability. Kind of going back to what you said a moment ago, though, because let's talk about numbers for a minute and data,
okay,
and why it's not necessarily something I enjoy. Being a computer science major, that's what I was in college. Been selling real estate, never did anything with it, but math numbers have always come secondary to me, right? I mean, it's something I understand. It's something that is easy to apply in different situations. And one thing about the news media, one thing about YouTube or anything, a headline, is that people have to get you to click on it, right? Whether it be a podcast, YouTube, it doesn't matter. And so that leaves a lot of the story out, the context out, right? So when I tell a story and I say, the one thing when it comes to headlines, a lot of the headlines don't give context. They don't provide the real story. And so you'll often hear somebody talking about foreclosures being up year over year, or whatever the story they're trying to tell is. And then when you actually go in and look at the data, the numbers, so to speak, you get the real story. Okay, yes, foreclosures did go up, but they're only up, a couple hundred or whatever it is nationwide. So it's not really the real story. And so I like to try to provide some context when we're talking about some of these things, right? Rates, housing affordability, whatever it is related to housing, it's often fearful for a lot of people, especially in the situation that we're in right now, right? With home prices reaching a peak, mortgage rates reaching a near-term peak, so to speak, housing affordability setting at the lowest levels. That's scary for a lot of people because people want to own homes. People want to believe in the American dream, and they want to become investors or whatever it is. It's really easy to get caught up in the headline. And I think, again, the numbers tell the story. So I focus a lot on trying to provide information at a level kind of elementary, if you will, where people can understand it, dumbing it down, so to speak, in a way that, hey, use it like this, and it's a little bit more understandable. So you kind of asked the question, though, what are the biggest concerns at the moment, or what am I hearing a lot of? Yeah. I think the biggest one, honestly, is rates and affordability, and the idea that who can afford this. This is a conversation I have a lot on the podcast and on YouTube, and there's a lot of people out there that believe because they can't do it for whatever reason that no one can do it, right? Because I can't afford it, no one can afford it. So something has to change. And I've been in California basically 20 years. I mean, I started in real estate and mortgage when I came to California. And in 20 years, a lot's changed, but not a lot's changed. And you've heard the same stories that I've heard. 3 years ago, people were saying something's got to change. Housing is too expensive. And now it's 30% higher, 40% higher, and people still telling the same story. So yes, there's a lot of that out there. I mean, my goal is to try to make it understandable for the masses.
Yeah, so I think that kind of brings us to this point where some people are saying, well, I'm waiting for this to all crumble. I was just on a podcast last week where the guy said to me, yeah, I'm waiting for the foreclosures. And I know because I've looked at the data that you just referenced, he's probably heard somewhere in the media hype that there's all these foreclosures coming. And there may be an uptick in foreclosures, but it's so minimal and even projected to be so minimal that we probably won't even notice. It won't make a difference in the market from what we can see. And so it's like he's waiting for this thing that maybe he's got from this news story that is probably not going to happen. Would you agree with that?
No, absolutely. I mean, something I often say comes from a mentor of mine, that people buy emotionally and they justify logically. And so emotion is involved, whether you're buying a home, for an investment, for owner occupied, whatever it is. There's always a little bit of an emotion involved. Now, less when you're buying commercial real estate and doing some other things, but there's always a piece of it in there. And I think,
totally,
again, when fear gets involved in any way, it makes people even more emotional. And the idea that you might have missed an opportunity, the idea that things might not correct the way you want them to or see them, then it kind of generates this response that, well, I'm just going to wait until this happens. Okay, that's fair. I wouldn't say it's reasonable, but you got to do what's right for you. And I think that's where I see a lot of people sitting, right? They're sitting on the fence waiting for something to happen in one direction. I mean, I've got story after story of clients that either didn't buy and still don't own, or sold trying to time the market and got out at a good price, but now prices are up 30% higher than where they sold, and now they're not back in the market. And so there's story after story of things like that. And again, if that's what you got to do in your life, that's completely fine. You can't have the regrets that I think a lot of people out there have for that reason. And that's what I see a lot of.
Yeah, absolutely. What would you say? So we've kind of covered foreclosures. That's an easy one. What would you say to the person who is, really frustrated with the interest rate and they are waiting to buy for that interest rate to go down?
Yeah. So again, just Alan, going back on one thing about foreclosures that I want to point out is depending on what state you're in. If you're listening to this, you're probably in California. California foreclosures take minimum 9 months, 12 months on average to go through the system. Understand that if you're waiting on foreclosures, guess who else is waiting on foreclosures? Everybody just like you, and a lot of bigger funds that have a lot more money than you do in a position to buy homes, not necessarily in bulk, but pay cash for them. As somebody who sold a lot of foreclosures for Fannie Mae, Bank of America, Wells Fargo back in 2009 through 2012. I mean, that's how I survived the recession, so to speak, is that I sold foreclosures. I was given property. I didn't have to do a lot other than sell them. And I had to maintain them and do a lot of work on that side. But I wasn't out there fighting for the masses of trying to list property. But what that did is it gave me a lot of insight as to not only how foreclosures work, how banks operate and deal with them. But one thing to know about foreclosures is that these banks are now a lot smarter than they were back in 2008, in the sense that towards the end of that, they realized, hey, we can actually sell these properties for market value. We don't need to let them go for a discount. If we just do a couple of little things here to these properties, we paint them, we put carpet in them, we put appliances in them, we can actually get pretty close to market value. And this was at a time, again, we were going through supply changes and just different things in the market with regards to inventory. But towards the end of it, they were getting pretty much market value for this. So I look at the market now going, foreclosures, you got $30 trillion of equity in property, right? And any foreclosures that happen, are people that are probably distressed to some extent, right? They have to be in order to go through equity and that sort of thing. But that doesn't necessarily mean the bank is going to take it and just sell it for 10 cents on a dollar to anyone to buy. They're going to try to get the most out of that property to maximize profit, which means that you're probably not really getting a deal at the end of the day. You're getting what a home down the street, an existing home would sell for at the same time. So I know I kind of went off on a tangent there, but I think it's important to understand foreclosures, not just in the sense of, hey, it's a distressed property that they're going to lose it and the bank's going to sell it. There's a lot more that goes into it than just that.
Yeah. And I would say, I guess this is maybe in the foreclosure conversation, one of the things I'm keeping my eye on, I'm not like extremely concerned about it, but I'm always looking for where are the vulnerabilities in the economy, and in particular, the real estate economy is my world. And it's the media has come up with a hype title for it, but they would call it like the office apocalypse, right? Yep. So you have all these office buildings, and I've done a lot of commercial real estate as an agent. I actually have an office listing right now, and it's sitting empty, and it's because the company consolidated, and so many people are not working out of the office now, and so you have this office space all sitting empty, and that's nationwide, not unique to California. Some of those office building owners are likely defaulting or needing to renegotiate those loans. A lot of those commercial loans come due, every 5 years or whatever. It's just an interesting thing that's going on, especially in the real estate economy that I'm keeping my eyes on.
Absolutely.
I don't know how much it's going to affect us. I don't know that it's going to affect us much. Some of the office is going to be absorbed into being converted into residential, but that's not easy to do. Like, it's just not easy to convert an office building into condos, right?
No, agreed. And I'm with you on that page. I think the commercial sector has a lot further to fall because of the things you mentioned, financing being a big issue, right? The small banks that had issues, a lot of those guys did commercial loans, and they did them for smaller investors and or some bigger investors. And so once you pull that piece out of the loan pool, so to speak, where you can go get financing, it creates other issues. And so now there's less options out there for people to finance these buildings when they're vacant. The rent cap is completely different, right? Because now when you go back into the bank to try to get financing, you're showing the rent roll. Rent roll might show zero because there's no one in the building. The loan no longer performs as far as the bank sees it. Very difficult to get financing, and that creates other issues. With that said, how does that translate into the residential market? I don't know. I see it two ways. I see one is anybody that would have typically been a commercial investor now might look for residential because rents are still staying strong and looking to put that money in other places. Or, maybe the bigger funds, those guys, the BlackRocks, all of those guys, I think are not really affected as much as the media wants to portray it, so to speak. But
Right.
it's tough to say. I mean, it's definitely something to pay attention to, but I wouldn't be counting on, a commercial office building in New York City defaulting to help you get a property here in Southern California or what have you. So.
Right. All right. Well, that's foreclosures, because that does come up in these conversations. Let's talk about interest rates. I think as an investor, you can avoid interest rates completely by just doing some creative financing techniques. So that's a whole different conversation and a different strategy. But let's say we are not able to do a creative financing technique. And so let me just back up as well and make sure I unpack that. So by creative financing, what I mean is there can be all different strategies. One big one is seller financing. So that's where the seller would finance me on the property, actually act as the bank. I would give my down payment. And it's usually a seller that has very little debt or no debt on the property. And I give them a down payment, and then I will make payments to them. It's really convenient. You don't deal with appraisal. You can negotiate everything as like you can't with a bank, but with a seller, you can negotiate the interest rate, you can negotiate the payment, you can negotiate how long it's going to be, everything. But let's say that's not the situation in a transaction or strategy I'm looking at, and I need to deal with interest rates. What are your feelings on the interest rate going down and me waiting for it to go down? Or let's just unpack some of the hot topics on interest rates.
Yeah, I mean, it's not an easy one. I've been wrong about rates for the better part of a year, just thinking that rates couldn't go as high as they've gone. I'll say that being transparent, right? I don't have all the answers. But what I look at is I look at government debt. I look at, the interest that we pay on our government debt. And where we are as a nation, and realizing that the higher they hike rates, the more interest we pay on that debt, and just how it affects everything else in the economy. And so that's one reason I didn't think we could get this high. Secondly, is I thought inflation would probably come down a little bit quicker than it did. We have some lagging indicators out there with shelter and rent data. We just had a spike in gasoline month over month, which caused inflation numbers to come in a little bit high this past month. So all of that said, trying to pick a top or a bottom in a market is very difficult, whether it's investing, whether it's buying for yourself, whatever it is. And so what I've seen is a lot of people that have tried to do that have ended up doing one of two things. Either ended up not buying at all because they just, when the opportunity was there, they thought there was going to be a better opportunity, they never acted, or it was just never the right time for one reason or another, never got to where they thought it was going to go, and therefore they're still sitting on the sidelines waiting for the correction to happen when it might have already happened. So that said, rates will come down as inflation continues to ease. The question is that going to be 3 months from now? Is it going to be 6 months from now? Hard to say. The Fed has a history of going too far for too long. They did it.
Yes.
They did it with transitory inflation. They did it by keeping interest rates too low for too long. And now we're kind of on the flip side of it with hiking
Yes.
rates and some of the data lagging and thinking that it's not where we want to be. So we continue to push and push and push until we break something or we don't. Because employment numbers are still reporting where they're okay, I guess, as Fed looks at it, then they're still in a position to continue to hike things and things are okay. I don't necessarily agree with that logic, but what I will say is that there are areas of the economy, a lot of the economy is starting to show slowdown, right? And as growth slows in the economy, that means inflation is going to come down in and of itself, whether it's the Fed raising rates for 12 different times or just the economy stalling to some extent. That's going to bring inflation numbers down. Rent data, shelter data is high all the way through March of next year. As the numbers continue to report over the next couple of months, it's going to make up less and less of inflation, and inflation numbers are going to come down. The question is, are they going to come down enough for the Fed to make an announcement and say that they're done, or are they in a position where they're kind of stuck until they see it for an extended period of time, and then at which case they'll kind of go along with what the market is wanting to hear. And I've talked about it in videos and why I don't necessarily believe that they're willing to do that. I think rates are going to come down. At the moment, what you have is you have a lot of willing people. I always talk about the willing and the able, right? The willing are people that are willing to own homes, willing to buy investment properties, willing to do whatever. That's pretty much everyone. Everybody wants to be a homeowner, wants to be an investor, wants to have cash flow. That's the majority of the market. There's the able, the people that are able to actually do it, that have the down payments, the property's cash flow, the interest rate makes sense, they can actually afford it, whatever. Those are the able. There's a lot less of the able at the moment, right? Because of where rates are, because of where prices are. And it's something I look at as somebody that sells residential real estate to primary homeowners for the most part, right? A lot of first-time home buyers buy property, a lot of move-up buyers, a lot of families. It's something I struggle with because I realize it is a problem. There needs to be a solution. But the problem is I kind of started the show with, everything always comes back to the data. And at the moment, supply and demand are both very, very low. And so in order to see a meaningful change in the market, whether it be investment, whether it be primary, whether it be secondary homes, whatever, you need an increase in supply. You need an increase in inventory. And we're just not seeing it. And so that creates these hurdles that we're talking about. And, as interest rates come down, which they're going to, that typically stimulates buyer demand. And as you put more demand back into a market where there's not a lot of inventory, you kind of create these scenarios where there's, prices could go up higher. You get bidding wars, you get different things that, again, I don't have the answer for. I don't have the solution for. Right. So I'm a solutions person. I like answers. I said I'm a numbers guy. Numbers make sense. None of this stuff makes sense because there's not a fix to it. And I think that's the struggle for a lot of people.
No, that totally makes sense. I think there's all these people that are telling us that they're waiting for the interest rates to go down. And that causes some concern because what is that going to look like when the interest rates do come down? Are all these people going to be, jumping onto the bus sort of thing? And now we're going to have 20 offers on a property again? I don't know. I don't know how many.
Yes. Yeah, I think that's
probably yes. Right.
Yep.
And as an investor, when there was 20 offers on the property, I was out of business if I was a buyer. Like I couldn't compete. The only way an investor can compete in that market is if I find something off the market that no one else knows about. That's my only hope. If I'm competing on an open marketplace with the entire world, I just didn't even have a chance in that market. And so that tells me as an investor that I might actually have a window of opportunity right now until those interest rates do go back down. And then you can create opportunity in any market depending on your skill set. But that is interesting that I'm hearing that a lot, and you're agreeing with me that you're hearing it a lot, that people are saying, well, we're waiting for the interest rates to go down. So it's like, and then you constantly hear the conversation of when are they going to go down? When are they going to go down? And I honestly don't think it's going to be till next year. It might even be a whole nother year from now, because I think you're right. Exactly how you said it, that the Fed, when they do things, they stick with it and it pushes it until something breaks. I just think interest rates, from my understanding, is their main weapon against inflation. Absolutely. And so they're just going to keep using it until they've had this data running for a certain amount of time that says, okay, we've quenched inflation and we're good. We can start lowering these rates. Would you agree with that?
Yeah, I do. I just, again, it's supply and demand, right? And you when you lower rates, you create more demand. That will create some more supply, right? Because some of those people that have been waiting
True.
on the fence to buy the home for lower rates are also sellers.
That's
But
right.
again, the struggle is that most people, when they sell a home, they buy another home. They don't sell and decide to go rent. They don't sell
Yeah.
and become homeless. They don't sell and go live with their parents. For the most part, it does happen. Most people sell and buy something else. So when you sell one and you buy one, you're essentially taking one off the market, giving one, so there's no opportunity for inventory to grow.
Right.
And in
Right.
order to see that change that we're talking about, you need property to come on the market and stay on the market and build to create more opportunities for home buyers out there. And the waiting mentality is two things. One is people are waiting because they want it to be more affordable, right? The payment's just too high. I could say I'm in that camp, right? I mean, I have, a property I've owned, now for the last 10 years is my primary home. I've owned several investment properties, but at the moment just own one property. My wife and I want to move, but if we move, I'm not getting rid of my house. I have a 3%, 2.99% interest rate, so a 3% rate on that property. It cash flows in and of itself about $2,200 a month as it sits right now, right? Without rates going any further. I'm not letting go of that. But the opportunity, I mean, the difference is I look at, okay, I bought that property in 2012. The property's almost tripled in value from when I bought it. But guess what happens is now I go out and try to buy something else. I'm buying something that's at least 3 times that price, which means my property taxes are 3 times that price on top of an interest rate that's really double from where it is now. So it's kind of this overall shocker, and I don't have to do anything. So I'm kind of like, I'll just kind of wait and see where things go. So there's that portion of the population, but there's also a portion of the population, which I believe this makes up a great deal of them, are the people that are now priced out. They can't buy a home at 7% interest rate. They could, the property they wanted. Maybe they were looking at an $800,000 property. Now, because of where rates are, now they're at 700 or 675 or whatever it is. And like, once you start looking at $800,000 homes and now you're telling me I got to look at a 675? No, that home's ugly. It doesn't have the bedrooms, doesn't have the yard. My kids got to play in the street, all of the different things. And that's why I tell people when they're looking at property all the time, let's start where you want to be. Let's not go above it, because if we go above it, guess what? You're going to end up buying above it because it's going to be a nicer property in a nicer area. It's going to have more of the things that you want in it. And so there's people out there that are waiting for that. And I think that's those are the opportunities in the market. The people that can afford it right now, I think have the best opportunity because, it's not great, but at least you're in. And if rates do come down, you can refinance. And if rates go up, guess what? You're in. Like, you don't have to worry about the what if they continue to go up. It gives you an opportunity. So
one thing interesting for me was I got into a loan product. This was over a year ago, but I got into a 40-year loan on actually this property that I'm in right now. And that brought the payment down. And, my mindset, again, as an investor is, even though this is my primary home, but is to pay down the debt as time goes by. I don't want to just ride it out for the entire 40 years. But it's just nice that I have the option for that payment to drop down. I haven't heard that the 40-year loan has really hit it big, or I'm the only one I know that has one.
Well, it's basically, it doesn't meet qualified mortgage guidelines. So it can't be sold to Fannie or Freddie. It's basically a non-QM loan.
That's it.
So most banks don't do them. They are out there, typically come with a little bit higher rate, depending on when you got it or whatever. But there's just not a lot of banks that do them. So the majority of people buying their homes don't have the option for a 40-year mortgage. It's not even something to consider. So therefore, it's not common knowledge.
It might be interesting if they get it to the point where it could be more of a...
They would have to rewrite the QM guidelines, which basically the non-qualified mortgage guidelines that basically came in after Dodd-Frank back in 2010, I think.
Yes.
And, that's prevented, that's one reason that we're not in a mess right now is because they got rid of all the risky financing that we did. And I think 95% is the stat I read yesterday. People that own homes have a 30-year fixed mortgage, 95% versus back in 2008, I think it was like 35% of people had an ARM of some sort.
Wow.
So big difference.
And that shows stability as well.
Absolutely.
That's major stability. Like I talk about, so in my market in Santa Barbara, there is so much stability in the real estate market here because the amount of debt on homes here is very low. And it is a wealthier, oceanside community. But because of that, a lot of the people that are buying here have sold other real estate and bought in, or they've exchanged up for years or for decades. And so they have very little debt on their property. So if things do go south, this is the sort of area where it just doesn't get impacted as much as like a city like Detroit could, or some of the other cities where there's just a higher debt ratio on the properties.
No, I agreed 1,000%. I mean, yeah, you're in a more affluent area and people have equity. And that's something that I try to tell the average home buyer, the person looking at a home all the time. Is like, stop looking at the value of your home. It doesn't matter. Can you afford the payment? Do you have some time on your side? Because those are the things you need to think about. Like when I bought my home that I'm in right now in 2012, I didn't think, I wonder what this thing's going to be worth next year. I was like, I got a wife. We just had a kid. Going to have more. Like, we need a place to live. And we want to be by the beach. We want to be, where we are. And it was just the right move. And so that's something I'm often talking about, is buying when it's the right time in your life, not necessarily trying to look at all the other factors that you can't control, because you can't control them, right? What can you control? Your finances, what you're comfortable with. And that's really what you got to focus on. Investing is a little bit different, because sometimes the deal either makes sense or it doesn't, right? I say investing is less emotional, because either the numbers financially make sense or they don't. And some people are okay being negative every month by a couple $100 because of the appreciation, especially when it comes to California, because the appreciation over like a 30-year period is like 7% or something here in California. It's pretty crazy. And so you're okay. But it's less emotional than it is buying a home that you're going to put your family in.
Absolutely. So let's wrap up with, I see a bit of an opportunity right now in the interest rate being where it is, in that you've heard the saying, date the rate, marry the property. Mm-hmm. So unpacking that, meaning, okay, I'm going to buy right now with a little bit higher interest rate. And I can make it work, knowing that in a year or 2 years, in a few years, I can refinance that rate and it's going to drop my payment significantly. And in my mind, in doing that, I'm buying a property with much less competition right now, much less offers that I'm competing against, than if I wait a year or two and I buy it then, and I might pay $50,000 or more because I get in a multiple bid situation. Would you agree that that's an opportunity right now?
I think it is, depending on your market, right? Real estate, we always talk about, it's local. A lot of markets are still hot. I mean, here in Orange County, where I'm located, as of yesterday, we had just over 200 homes on the market, right? We're a county of 3.3 million people. This is, the highest number we saw this year of available homes on the market was like 230 or 240. It was pretty low. We started the year, I don't remember where we started the year, 160 or something. So we've seen inventory go up. We've seen it come down. Our market is still somewhat competitive. If you list a nice home and it's priced correctly, right, it's probably still going to have multiple offers. So could it still be an opportunity here? Sure. There are areas that have more inventory and things are definitely a little bit slower. I think Phoenix is one of those markets at the moment. I get a report from a friend there every month, something that he subscribes to, something I trust, and their inventory is up, still down, but it's up from where it was a couple of months ago. And nevertheless, those are more of an opportunity market. But yes, I agree. I don't like the marry the property, date the rate saying, because I think it sets a precedent that you're going to be able to refinance quickly, soon, and not necessarily. And you didn't say that, and I don't necessarily know that that's the idea behind it. But what I did hear over the last year is a lot of people pushing that. And then what we saw was rates go even higher. And then they went even higher. And people are going, what? Like,
so the question is, if I'm dating the rate, how long is this date going to go?
Yeah, you better really like that date for a period of time, right? Because I think there's so many unknowns in the market. Things can stay irrational longer than you can stay solvent, right? That's one of the quotes out there when it comes to trading stocks, and I think it applies to this sort of thing as well. Is like the market can remain irrational. And I think it is irrational in many different levels. And so, yes, I do think rates are going to come back down. There's going to be an opportunity to refinance. But I think we're going to see this grind back and forth on rates for a period of time until you see some real numbers come out and or something big starts to happen in the financial markets where the Fed has to react a little bit more aggressively. And so, but again, it comes back to supply and demand. If you're in a market that has a ton of supply that's not moving, that's your opportunity. I mean, those are the golden opportunities. But if you're in a market that has no supply, the idea of going in, offering much less on a property and doing these crazy things that I hear people talk about doing, it's like, no, you're wasting your time, because there are still markets out there that are moving. People
Yeah.
still bought homes in the financial crisis, of 2008. And there were still transactions happening during that time.
Oh
So
yeah.
there's always people buying and selling real estate, just a matter of,
Yeah.
at what price.
Yeah, and I like how you say it's local specific. I would also say it's property specific. So people will say to me, "Hey, Alan, is right now a good time to buy?" And I say, "Show me the property you're looking at."
Yeah, could
And
be.
tell me why you're buying it. And I think there's certain categories as well in properties that are way more competitive than others. So, of course, the most competitive is going to be when you're in that first time home buyer category. So, whatever that price is in your market, if there's a 3-bedroom, 2-bath that doesn't have a lot of problems to solve, because I like properties with lots of problems. The more problems the property has, the better for me as an investor, because I solve problems. That's what I'm trained to do. So if there's a property that has 0 problems, it's a 3-bedroom, 2-bath, which is a great combination for a family who's buying their first home, and it's in that price range that is the first home, that home price range for first time home buyers in your market, then it's going to be competitive.
Watch out.
Right?
Yep. Absolutely.
Yeah.
Agreed. Yeah. And I think that's the idea is to buy what's right for you when it's right for you. For each market, it's a little bit different. The median price point, for different areas is the most competitive, median and or lower. So in Orange County, if it's under 1.2, pretty competitive. And now for other areas of the country, they're going, dude, 1.2, that's crazy. That's a mansion. It could be here in California. Unfortunately, it's not. But then you go to areas of Florida where, it's like Panhandle in some of these areas where, the median home price is $350,000. Well, that's the competitive price point in that market.
Yeah.
The luxury homes are the ones that kind of sit. So to each his own when it comes to that sort of thing.
No, I know. I just bought a fixer for 2.5, but it has full ocean views. The Santa Barbara harbor views. You see all the sailboats. It's up on the hill overlooking just incredible views, but has tons of problems. Old aluminum windows, old roof, all the bathrooms, all the kitchen, everything's old. I'm the problem solver, right? I'm going to come in and do all of that headache, all of that work, and then turn it, for profit, in exchange for taking care of all those problems. And there was another offer. There was only one other offer, but I think they got overwhelmed by the problems. There was one thing that they got overwhelmed with that I looked at and I'm like, that's not a big deal for me. They went away and I had 0 competition. So all of a sudden the negotiations were in my favor on this property. The seller had to sell. It wasn't the sort of, they'd already moved out. It was sitting vacant. So there is opportunities. Yeah, I just wanted to thank you for sharing just your insight and some of the data angles with us. Where can people go to be in touch with you and find out more about you?
Yeah, I mean, the main one is YouTube, right? I mean, I post a lot on there. Jeb Smith is my handle on there. So JebSmith. Transfers to Instagram, all of those different platforms. Reach out. If you're a first-time home buyer, I know this is geared towards a lot of investors, have a podcast out there called the Educated Home Buyer Podcast on Spotify, Apple, or YouTube channel around it as well. And that's kind of a deep dive into home buying. So depending on where you are in the journey, there's, episodes and things to kind of guide you through that process. But really, again, I'm all about education, whether it be rates, house prices, doesn't really matter. I often get seen as, hey, I'm another housing bull. I'm a real estate agent. I just want to sell houses so I make money. It's not it. Like, I make more money when there's more transactions happening, right? I mean, 50 transactions a year versus 10, I make a lot more money. So, and this isn't a market where transactions are taking place. It's really just about providing education. I don't want to necessarily see higher prices. I'd rather see lower prices and more people be able to get into homes. And so, again, the channel is really about education. All of them are, and just kind of help people make sense of the craziness, of the fear out there in the market, and helping them make the best decisions. I appreciate the opportunity.
Thanks so much.
Absolutely. Thanks again, Alan.
Hey, thanks for listening to the California Real Estate Investor Podcast. We'd love a review on whatever podcast platform you listen to this on. Also, visit us at thecaliforniarealestateinvestor.com or our Facebook group, The California Real Estate Investor. We look forward to connecting with you and encouraging you on your real estate investing journey.